Not too long ago, deals were flying off the shelves. Interest rates were low, capital was cheap, and buyers were everywhere. But today, it's a different game. Interest rates have climbed, financing costs have surged, and yet property prices haven't dropped much. A lot of investors are asking, where are the deals? And many are focused on one number, the cap rate. But here's the thing. While cap rates give you a quick snapshot of a property's return, they don't tell the full story. Smart investors know that in today's market, other factors matter just as much, if not more, when making solid real estate decisions. And that's exactly what we're going to talk about today. If you're serious about investing in retail real estate in today's market, you need to go beyond cap rates. In this video, I'm going to break down some key factors that will help you find the right deals, protect your cash flow, and set yourself up for long-term success. Number 1, tenant quality and lease structures. When interest rates are high, the last thing you want is unpredictable cash flow. Your best defense? Credit-worthy tenants and strong lease structures. In this market, you need tenants who can pay, who will stay, and who offer built-in income growth over time. A fully leased property doesn't automatically mean it's a good investment. If your tenants are struggling, your cash flow is at risk. Here's what to focus on to ensure stability. Credit-worthy tenants, because rent is only as good as the tenant paying for it. Not all tenants are created equal. Properties leased to national or strong regional tenants are far more recession-resistant than those relying on weaker local businesses. How about national tenants? Think Starbucks, Chipotle, Planet Fitness, T-Mobile. They have brand power and financial backing. Then we have regional tenants who have multiple locations and a proven track record offering stability. In Texas, we have Torchy's Tacos, Specs, Academy Sports, among others. And then local businesses can also be great, but require extra due diligence. How long have they been operating? What are their sales per square foot? So before buying a retail asset, ask yourself, if the economy slows down, will these tenants still be around? If you're not that confident, reconsider the deal. Long-term leases with rent escalations, because flat rents mean lost money. A high interest rate environment makes rent growth more critical than ever. Without rent escalations, your income is losing value against inflation. Look for leases that include 2 to 3% annual rent bumps. This compounds over time, increasing property value. CPI or consumer price index-based escalations, which adjust rent along with inflation, protecting purchasing power. Also look for long lease terms with renewal options. A 10-year lease with structured growth beats a 3-year lease with uncertainty. If tenants are locked in with predictable rent increases, you're not just investing in a property, you're investing in a rising income stream. If a lease doesn't have rent escalations, negotiate them. Otherwise, inflation eats away at your returns. Essential versus discretionary retail, because some businesses thrive in any market. In times of economic uncertainty, not all retail properties perform the same. Some businesses are recession-proof, while others struggle when consumers cut back on spending. Essential retail like grocery stores, medical, auto repair, discount stores, specialty markets. These are all businesses that provide everyday necessities and services that people rely on regardless of economic conditions. These tenants are recession-resistant, drive consistent foot traffic, and offer goods or services that consumers need frequently. On the other hand, discretionary retail refers to businesses that sell non-essential goods and services, meaning consumers typically spend on them when they have disposable income. Unlike essential retail, these businesses are more susceptible to economic fluctuations, as spending on discretionary items tends to decrease during downturns but can thrive in strong economies. If you want long-term stability, invest in properties where people have to shop, not just where they want to shop. When assessing a tenant, ask yourself, would this business still make money if the economy slowed down? If the answer is no, you might want to rethink that tenant. So to ensure cash flow stability in a high interest rate market, investors must focus on creditworthy tenants, long-term leases with rent escalations, essential retail over discretionary. Here's another focus when it comes to retail real estate: market fundamentals. The right location still wins. You've probably heard it 100 times. Location, location, location. But in today's high interest rate environment, it's more than just a cliche, it's a strategy. When your financing costs are elevated and property pricing hasn't come down much, you can't afford to buy in a market that's soft or uncertain. The strength of the market you're investing in can make or break the deal. Let's break down what to focus on. Economic and population growth. Markets with strong job creation, new infrastructure projects, and increasing household incomes consistently outperform slower markets. This is simply because people drive demand. If an area is adding jobs and attracting new residents, retail will follow. More people means more spending, and that translates to stronger tenant performance and long-term stability. An investor should be thinking, before I look at the deal, I look at the market. If the market isn't growing, neither is my income. Next up is retail demand and vacancy trends. You've got to know the balance between supply and demand. Overbuilt markets, where there's too much retail square footage and not enough consumer demand, tend to struggle when the economy slows down. Vacancy rates go up, landlords start offering rent concessions, and returns take a hit. A key focus here: don't just look at how full a shopping center is. Look at how the market is performing overall. And don't forget about traffic and accessibility. Properties in high visibility locations with strong traffic counts and easy access always outperforms the ones tucked away or sitting in declining trade areas. Retail thrives on convenience. If a tenant's customers can't easily find or access the space, they likely won't succeed, and that impacts your bottom line. Even in a down market, well-located assets with strong local demand tend to hold their value better than properties in stagnant or declining areas. You're not just investing in a building, you're investing in the ecosystem around it. Cost per square foot and replacement cost. Avoid overpaying in an inflationary market. When interest rates are high, every dollar you spend has to stretch further, and that means being laser focused on value. One of the smartest ways to protect your investment in this environment is by understanding how your purchase price compares to what it would cost to build the same property today. Here are some things you need to focus on. Acquisition price versus replacement cost. If you're buying a property for less than it would cost to build new, that's a built-in buffer, and it matters more than ever right now. When development costs are high and financing is expensive, new supply slows down. That makes well-located, existing assets more valuable simply because they're harder to replace. Think of it as buying below market for tomorrow's standards. An investor should be thinking, I want to own assets that developers can't afford to replicate right now. That gives me a competitive edge over time. How about construction and land costs? Material prices, labor shortages, and rising land values have pushed construction costs through the roof. Combine that with expensive financing and many ground-up retail projects that just aren't penciling out. That's good news for existing and future owners. If no new product is coming online, demand consolidates around well-located existing centers, and that supports occupancy, rent growth, and long-term appreciation. A third focus point related to replacement cost is retailers' occupancy costs. This is a big one that often gets overlooked. Can your tenants actually afford the rent you're charging? A good rule of thumb: retailers should be paying no more than 10 to 12% of their gross sales towards rent. If their rent is too high relative to what they're bringing in, they're at risk of default, and that puts your cash flow at risk. Before you buy, study tenant sales where possible and make sure rents are aligned with market realities. In high-rate environments, buying below replacement cost gives you an edge. If new construction isn't financially viable, existing assets become more valuable by default. It's simple supply and demand. The fourth key focus area is property location and asset quality because long-term viability matters. When you're investing in retail real estate, you're not just buying what the property is today, you're buying what it can be tomorrow. That's why both location and asset quality are critical. In a high interest rate environment, the ability for a property to stay relevant and profitable over time is what separates the solid deals from the short-lived ones. Let's take a look at these key components. In a high interest rate environment, the ability for a property to stay relevant and profitable over time is what separates the solid deals from the short-lived ones. First, locations with strong consumer demand. Not all locations are created equal. Retail centers in growing residential areas, near major commuter corridors, or in dense urban neighborhoods will consistently attract tenants and foot traffic. All because retailers go where the people are. If a property sits in the path of growth, it's positioned to succeed and hedges best against a market slowdown. The investor mindset should be, location is your built-in insurance policy. If the market shifts, demand in top trade areas is the last to soften. The second key component is looking to see if the property has been well maintained. Let's face it, deferred maintenance can kill your returns. A roof that needs replacing, outdated HVAC systems, or a crumbling parking lot might not seem like deal breakers on paper. When evaluating an asset, factor in not just the purchase price, but the real cost of ownership. Properties that are clean, modernized, and well managed are easier to lease, command higher rents, and retain tenants longer. Bottom line, a good location doesn't excuse poor condition. You need both. Finally, consider the adaptability for future uses. Retail is always evolving, and your property needs to evolve with it. Ask yourself, can this space be reconfigured for medical or wellness tenants? Is there potential for other uses and redevelopment? Properties with flexible layouts or value-add potential give you options, and options are leverage. The more ways you can reposition or repurpose a space, the more resilient your investment becomes. A great location never goes out of style. Even as shopping habits evolve, well-placed properties can be repositioned for new uses and continue to create value long after the original lease expires. Here's my fifth and last key focus area retail real estate investors should prioritize in a high interest rate environment. Long-term perspective in playing the long game. In a market where interest rates are high and uncertainty is everywhere, it's easy to get stuck in short-term thinking. But the truth is, real estate has always rewarded those who play the long game. While others are waiting for the perfect moment, smart investors are making moves that position them for long-term growth. Let's talk about how to think beyond the current headlines. Interest rates are cyclical. Rates may be high today, but they won't stay there forever. Historically, interest rates move in cycles. What's expensive to finance today could become a strong cash flowing asset tomorrow once rates adjust. If the underlying fundamentals are strong, like location, tenant mix, and lease structure, it's still a good investment, even if the financing isn't ideal right now. Investors should be thinking, I don't buy based on today's interest rate. I buy based on the asset's ability to produce value over the next decade. Part of playing the long-term game is strategic refinancing. Many investors overlook the power of a strategic refinance. If you buy well now, even at a higher rate, there's potential to refinance in 3 to 5 years and unlock significantly better cash flow. This is especially true if the property includes rent escalations, value add potential, or market growth. You might not be getting ideal returns on day one, but the upside is in the hold. Finally, investors should consider 10-plus year trends. The best investors zoom out. They look at where a market is headed, what developments are planned, where population is moving, and how retail is evolving. If you're buying a property you wouldn't want to hold for 10-plus years, you probably should rethink buying it at all. Time in the market beats timing the market, every time. The best investments are made with a long-term mindset, focusing on quality assets that hold value over multiple cycles. In a high interest rate environment, the deals that succeed aren't always the ones with the highest yields on paper. They're the ones with solid fundamentals underneath. If you're investing in retail real estate right now, here's what you need to focus on. Tenant strength and lease structures. Stable, creditworthy tenants and built-in rent escalations protect your income and reduce risk. Market fundamentals. Location still rules. Invest where the population is growing, jobs are being created, and demand is rising. Cost per square foot versus replacement cost. In an inflationary market, Buying below replacement cost gives you built-in value. Property location and asset quality. Well-maintained, well-located properties are easier to lease, more adaptable, and more resilient through market shifts. Long-term perspective. Real estate is a long game. Think in cycles, not moments. Buy smart, hold strong, and position yourself for the upside. If this brought you value, please hit that like button, subscribe, and turn on notifications for more commercial real estate insights coming your way. This was Ray, CRE Broker. See you next time.